Happy New Year. What, you don't like my intro?
I like it.
Okay. Happy New Year. Not only with the turn of the new year comes the restart of healthcare deductibles, new thresholds and limitations, and much, much more, but also the new year marks the end of another tax year. That's right, folks. We're talking about taxes here today on Healthcare and Retirement. Welcome back, everyone, to Healthcare and Retirement, golden advice for your golden years. I'm your host, Trey Basa with Market Medicare Advisors, a licensed health insurance advisor. And today, I'm joined by my good friend and coworker, Lauren Dietz from Market Tax Services. Before we get into the nitty-gritty of today's episode, why don't you tell our listeners that you're experienced? I didn't just pull you off the street to come in for this recording. Tell them about yourself today.
He did. I'm just kidding.
Wow, thanks.
No, my name's Lauren Dietz. I am a licensed tax advisor. I'm an enrolled agent, so I am licensed through the IRS. I had to take a series of tests. So that means that I can represent clients to the IRS, just like your CPA would. I've worked for Market Tax Services for about 5 years now, and I help Joshua Sikora, our lead CPA, run the whole shebang.
And it's not just tax season that you are working. Joshua, you, the whole team are working year-round for all of our clients. And as we get into today's episode, as we talk about some of these cases that we're working on with clients today, you'll realize why it's important to have the health advisor, the tax advisor, financial estate advisors under one roof. To kick things off on today's episode is our first segment, In the Know. Market Medicare Advisors is dedicated to keeping you in the know with all things healthcare and retirement. Our segment today is going to be a dive into what you need to know before you retire. I have a list, 3 things we're going to talk about concerning both Medicare and taxes. That first one is often the one that I run into the most with my clients is HSA contributions, health savings accounts.
Yeah.
Let's talk about that. What is an HSA?
So a health savings account is an account that you can have if you are on a high deductible health plan. A lot of employers offer a lot of times different health plans that you can sign up for. I personally use an HSA because I love it. But you can contribute to that throughout the year. It's pre-tax contributions, so kind of like if you were to contribute to an IRA or 401k, which is really nice. And they've got pretty good limits. If you're just an individual, it's a $4,300 limit for 2025, and then for a family account, it's $8,550 for 2025. So that's a lot of money that you can go set aside to use at any time in the future for qualified medical expenses. That covers a lot more than people even think about.
So before we get to the qualified medical expenses, I want to highlight the main benefit from a health savings account is that money
is a pre-tax deduction, which is really nice.
So you can contribute your portion to up to that $4,300 for an individual, $5,500 for family, $8,500 for a family, without deducting any taxes. So you don't get a tax benefit now versus like what is it? Just your regular FSA?
So you do get the deduction in the year that you're contributing to it.
Okay.
Just like you would if you were contributing to a traditional IRA. You get that deduction now, but all of those medical expenses that you're using or that you're paying for through your HSA, it's tax-free money as long as they're qualified medical expenses. It's a really nice thing. And not only that, you can also, depending on how much money you start putting in your HSA, a lot of employers or a lot of these HSA custodians allow you to even invest that money in the market like you would with a retirement account. And so it's a nice thing. They also have, for contributions, you can contribute up until April 15th of the following year for the previous year like you can with IRAs. So maybe you didn't quite hit your maximum that you can contribute in the calendar year. Well, you still have time.
So this money going into it is pre-tax. You can only spend it on qualified medical expenses. And that's going to be the second thing that I wanted to talk about, because A lot of times in retirement, as we age, we become just a little bit more needy medically, and all of these expenses can add up. So to transition over qualified medical expenses, what are some examples of those, and how can people use that to their tax advantage?
Sure. So there's a lot of things that that are considered qualified medical expenses. Anytime you go see your doctor, if you've got prescriptions that you have to pick up, anything out of pocket that you're paying, those count as a qualified medical expense. Anytime you have to go see any kind of doctor, a specialist, chiropractors, dentists, all of that counts. As well as, even depending on your situation, there are scenarios where if you have to have a gym membership because you are on some sort of weight loss plan, you can sometimes deduct those. Now, that doesn't count for everybody, but it can. But there's a ton of any kind of operation you might need to have, whether it's on your eyes, your teeth, any sort of surgery. Those are all qualified medical expenses. Now, when you are wanting to try to itemize on your tax return, there are a couple of hurdles that you do have to cross in order for those to start counting in your favor. So a lot of people, they're like, oh, well, I spent $500 last year at the doctor. Well, you can only deduct your qualified medical expenses if you're itemizing. Mm-hmm. And some states allow you to itemize separately from the federal return. So like we're in Kansas. Kansas allows you to itemize separately, even if you take the standard deduction. But you also have to have enough medical expenses in excess of whatever 7.5% of your adjusted gross income is. So say you make $100,000 a year, you'd have to have at least $7,500 worth of medical expenses before it starts helping you. But for a lot of people, especially older folks, they may have a lot of out of pocket, and that includes long-term care. And that adds up very quickly.
Not to mention in retirement, your income is going to be reduced. You're not actively working.
Right. Most people make less in retirement than they did in their working years.
So when we're adding up all these qualified medical expenses, they have to reach that 7.5% of your adjusted gross income?
Adjusted gross income, yeah.
And then you can itemize. Then it's worth it. But if it's not 7.5%, what do folks do?
Then they kind of miss out on being able to take advantage of that. But people also, I think they fail to consider the fact that this includes like your Medicare premiums, your health insurance premiums, whatever you're paying on a monthly basis. Those all count. And those, healthcare is not cheap.
No, it is not.
It adds up faster than people, I think, even like to think about.
So as long as folks have a very itemized list, they're tracking every expenditure, and they meet that 7.5%. Yeah.
Yeah, 7.5%. Yeah. And with like our clients that I work with, we have organizers that we like to send out to them to just help them when they're gathering all their documents. We don't necessarily want to see every receipt for all of your expenses that you had throughout the year, because it can be a lot.
Yeah.
But we basically are organizers that we like to put together, help them kind of categorize out, like, what was this expense? Like, is this dental? Was this vision? Was this premiums? Was this out of pocket, like doctor's visits? We help them try to kind of consolidate that information. So that's something that we like to send out every year. And we also have those available on request for our clients year round.
Helping keep clients
organized.
Nice and organized.
Yes.
You hit on Medicare premiums. I think premiums in general are just the most expensive cost for anybody in healthcare, and that ties into our third point, and that's the income-related monthly adjustment amount. Good old Aunt Irma.
Yeah.
What they'll do is they will look at your tax return. She does not play nice.
No, she doesn't.
The government will take a look at your tax return 2 years ago.
Yeah.
And then they will say, you had this filing status. This is what you pay for your Medicare Part B and D premiums.
Mm-hmm. They like to wait just long enough that you completely forget about it. And then you're like, oh, what's this?
Yeah, nice little surprise in the fall. They'll send you a letter and say, this is how much you're paying for your Part B and D next year. But I bring this up because it's important to have planning 2 years in advance, not even like in retirement, but leading up to
right.
retirement.
Like if you're 63, this is when you really want to start looking into this.
Would you say somebody 60s, probably decades into their career, are they earning more or less than when they started out?
I would sure hope that they're earning quite a bit more than what they started out making.
Absolutely. And just logically, they've spent so much time. They have built up their career. They're in their highest earning years of their life, approaching retirement. And in 2 years down the road, they're going to get with an IRMA upcharge.
Yeah. And it can be pretty devastating. I mean, there's multiple tiers of IRMA. The first tier is a little easier of a pill to swallow, but still, I mean, a lot of people, they're like, okay, I'm already forced to pay this much money for my Medicare premiums. I don't want to pay a penny over what I have to. So there is a lot of planning that goes into making sure that you don't trigger IRMA. And people, I don't think that they realize how quickly you can hit that.
It sneaks up on you.
It sure does.
And that's why we have market Medicare advisors and market tax services just always talking to each other, working on these cases for our clients years in advance. So if you want to stay in the know with all things Medicare, IRMA upcharges, qualified medical expenses, please feel free to give me a call at 316-252-8707, or you can email us at mail@marketmedicareadvisors.com and connect with us today. Our next segment for today is going to be the client case study. This segment, we're going to examine a couple that we are actively working with and helping them navigate their IRMA upcharge as they're preparing to wind down their careers and move wholeheartedly into retirement. Our story begins with, we'll call them Bob and Carol. 2 years ago, when they first came into our offices, Bob and Carol had an extra account, we'll say. We sat down and we went through our complimentary MAG report with them. It's where we do a little bit of investigation, see where they're at, and how we can better prepare them to live their best lives in retirement. Now, when we sat down with them, I think it was Joshua at the time, but he recorded some notes.
Yes, he did.
Yeah. What did Josh say about their accounts at that time?
Yeah, so we sat down, we were in this meeting with Bob and Carol, and we learned that they had a pretty sizable retirement account that had generated around $120,000 of capital gains in a single year. That's a lot. And that's not even money going into like their bank account. They're not really even seeing it. It's just money that's being generated from the sale of some of the securities that they had. So while they didn't tangibly get that money and take it out and use it for anything in that year, it still counts as taxable income when they go to file taxes, which is a bummer. Yeah, it's recorded.
So they had that $120,000 from capital gains.
Yeah, so that it bumped their income up to like $280,000, which is a lot of money, and that is definitely triggering some IRMA.
Yeah, like I said, this was about 2 years ago they first came in, and that's that exact time period we were referring to for IRMA. So this year, Bob actually sent me an email saying, hey, I got this upcharge notice from the government. And it's like, oh, okay, let me take a look at your tax return real quick. Yep, that looks about right. And I remember specifically Bob saying, guess we're just going to have to bite the bullet on this one. Unfortunately, there was nothing we can do about it at that time. It's because of that large sale that generated all those capital gains. And that is not a special exemption. There are things like the ceasing of income, the loss of a spouse, or the division of a marriage, a divorce. All of those different things, those are things that we can go into an appeal for and talk about possibly reducing the IRMA upcharge. But the sale, that is something unavoidable.
Yeah.
I just wanted to bring up with folks that we are actively working with our clients today to avoid this as best as possible. But if it's unavoidable, we are working to appeal and bring down those charges the next year. Because for Bob and Carol, they only have to pay more this year.
Right. It's a year by year thing. It's not like you go $1 over the IRMA cliff and you're stuck paying higher premiums for the rest of your life. But it is definitely something that if we can avoid it altogether, we definitely want to do that. We try to be as strategic as possible to help people at least mitigate, if not completely avoid IRMA.
At this point in time, I've already got a appointment with Bob and Carol end of this year. Hey, let's get together, get this paperwork all figured out and send it in so we can get that IRMA upcharge reduced, get to that base rate for Medicare Parts B and D. And I want you to take an opportunity to talk about a little bit more advanced tax planning that we're doing with folks to help avoid these IRMA upcharges, to help make sure we're reducing people's tax liability so they're not losing as much in taxes.
Right. So there's a lot of different strategies that we like to use with people that are either getting ready to enter into retirement or they're in their retirement years. We do a lot of tax planning in the last quarter of the year. A lot of it revolves around Roth conversions. And so when we are doing Roth conversions, especially getting into these larger amounts of Roth conversions, which basically, if you're not familiar with the Roth conversion, it's basically you're taking money from your traditional IRA, moving it to a tax-free Roth account, and then you're paying the tax on the conversion right when you do that so that that money can continue to keep growing tax-free in the future. It's a great tax strategy to help people mitigate having to be forced to take out required minimum distributions in the future. But when we do that, a lot of times, especially if we're looking at larger dollar amounts, we got to make sure that we're not triggering IRMA. And if we are, if it's really going to be for the best benefit of the client. Sometimes people have so much money in these pre-tax accounts that it's like they'd rather pay more in Medicare premiums for a year and get a lot of that moved. But this is a conversation that we like to have with all of our clients. And for some people, it doesn't make sense. And for other people, it does. Another thing that we like to do is tax loss harvesting. So if you've got a brokerage account where you had all of these stocks that have just not done well, and you've got a huge loss, sometimes we'll use that in a year where they can take this big loss and offset it from the sale or the gain of other stocks that are doing better. So,
all of this is just a glimpse at what Market Tax Services does to work hand in hand with our financial clients, our healthcare clients, our estate clients, because this is not some clear-cut path for every single individual to take.
No, not at all.
It depends on an individual, a couple, and their circumstances. So if you have a case that you want us to dissect or questions that you want answered here on the show, please shoot us an email at mail@marketmedicareadvisors.com. Give us your name and city so we can shout you out on the show. And as always, you can give us a call and schedule a meeting with Market Medicare Advisors, Market Tax Services, so we can get to know you and your situation a little bit better. Because if there's one thing I know, there is not a one-size-fits-all solution for retirement. It really, really comes down to the individual. Lauren, as we wrap up today's show, and I know you guys are hunkering down, preparing, this wild storm called tax season is coming up. Why don't you share with our viewers a little bit about Market Tax Services and your role here on the retirement team?
Right. So like I said, I am a credentialed tax preparer, tax advisor, really. I'm an enrolled agent. I'm licensed through the IRS, just like a CPA would get licensed through the state that they're practicing in. And I have worked with Market Tax Services for the last 5 years. Josh and I work really closely together. He's our lead CPA. We've got a great team of other enrolled agents and CPAs in both Wichita and in our Kansas City offices. We do a ton of working with Medicare, with the Medicare team like Trey, as well as all of our financial advisors and sometimes even our estate planning team. So we all like to communicate and stay in the know with each other and help people navigate that fun thing called retirement as best as we can.
Boy, howdy. You really do need the entire team together because there are so many different aspects. There are so many different nuances with every little thing, with your taxes, your financial planning, Medicare, your estate planning. Well, Lauren, thank you so much for joining me. That is going to be it for today. Be sure to subscribe to stay tuned for more videos just like these for all of your Medicare needs. Don't forget to like and share so you can help your friends and family by getting them the information they need to know about their Medicare premiums, policy, tax obligations on their Medicare premiums. You can catch this show and an entire catalog of shows on our YouTube channel, youtube.com/retirementhelp, where we archive all of our previously recorded and aired TV shows, radio shows with professionals like Lauren for Market Tax Services or me for Medicare Advisors, as well as our other in-house professionals focusing on financial and estate planning. Coming together in one place to talk about how we're actively working with clients today to prepare them to live their best lives in retirement. I've been your host, Trey Basa.
And I'm Lauren Dietz.
Thank you so much for joining us here on Health and Retirement, the talk show of golden advice for your golden years. We'll see you next time.
Unless otherwise indicated, all client and prospect names mentioned on this show have been changed to protect the identities of the individuals discussed.
The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers. This is not endorsed or affiliated with any U.S. government agency, the Social Security Administration, or associated with any federal Medicare program. We do not offer every plan available in your area. Any information we provide is limited to those plans we do offer in your area. Please contact Medicare.gov or 1-800-Medicare to get information on all of your options. Investment advisory services are offered through Foundations Investment Advisors LLC, an SEC-registered investment advisor. All rights reserved.